If gold moves on up and we compress, let's get the good old calculator out, guys. Let's see what that's going to be like. Let's say we compress the ratio down to 30 to be conservative. Let's say gold's at 4,500. We go to 30, $150 an ounce silver. Pretty easy math. Yeah, definitely possible as we break through this gigantic cup and handle pattern.
Gold prices are under pressure for the third straight session, hovering just above Thursday's swing low as the European session opens. While the pullback reflects a broadly stronger US dollar, the bigger picture hasn't changed. Silver is gaining ground fast, and the gold-to-silver ratio is tightening. It now takes 87 ounces of silver to buy an ounce of gold, down from 105 in April, marking the strongest silver relative to gold in 7 months. Silver's momentum has taken the lead. It's up 36% so far this year, outpacing gold's 31% rise. The metal recently came close to the $40 mark, still below its 2011 high of $49, but now clearly moving with intent. As both a precious and industrial metal, silver is benefiting from dual tailwinds: long-term investment demand and persistent industrial strength. The market is heading into its 5th consecutive year of structural deficit, and that's before adding in a wave of new investor flows seeking a cheaper inflation hedge. Andy Hose of FindingValueFinance still sees much more room to run. His target for gold sits between $4,000 and $5,000, and he believes the real move starts after gold breaks decisively above $2,100. He sees silver exploding even more dramatically. Historically, in major bull runs, the gold-to-silver ratio compresses to 30 or lower. If that plays out and gold hits $4,500, silver could climb to $150. Recent tariffs are adding fuel to the fire. The U.S. plans to impose a 50% import tariff on copper starting August 1st, and combined with tariffs on Mexico, this has already created distortions between U.S. futures and London benchmarks. The spread has pushed lease rates higher, particularly in the silver market. That kind of dislocation often drives volatility and opportunity. According to Hose, there's a familiar sequence unfolding: gold leads, copper follows, and oil trails behind. Right now, copper's chart is setting up for a major breakout, and silver and oil appear to be tagging along. The copper tariff, while seemingly isolated, has triggered movements across the broader metals complex. The commodity momentum is lining up, and silver is positioning itself as a standout beneficiary. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So Tavi says, despite copper reaching new highs, it remains at one of the most undervalued levels relative to gold in history. Notice that we are also approaching a potential major breakout in the copper to gold ratio. Copper has officially entered a price discovery phase, and in my view, this move is still in its early stages. We have the copper and gold price overlaid on top of each other, and they do move together. You can see gold front ran copper, which it did here too, and then oil is going to follow next. Copper to gold ratio, look at that downtrend line ready to break. Oh man, this looks good for copper. Copper sitting on top of its big pattern too. So I mean, this thing, this thing could be it's going to open some eyes perhaps. Silver's looks really good too. I think silver, copper, and oil are about to explode, is what I think. Capital rotations on track, so we are continuing to see that gold outperforms the Dow Jones. And this one here, yeah, that's gold and Dow Jones. So when it goes down, gold outperforms the Dow Jones. Everything is in alignment for this to occur here, guys. That's when you see copper break this downtrend. It's all interconnected, all of it. Ben Graham says, never buy a stock because it has gone up or sell one because it has gone down. And that's what everybody does. Everyone does that almost. Oh, I don't like this one. Well, why? Oh, it's gone down. Doesn't make the company bad. It could just be out of favor. What makes $3,000 an ounce gold prices look cheap? $4,000 ounce gold prices do. My larger target of $4,000 to $5,000 an ounce upside gold price on this accelerated cycle after hitting 2.1 thousand was wiped out remains in play. Gold and silver stocks are most likely going to finally explode higher. Gold hitting 4,000 is a walk in the park, says Tim Hack. Yeah, this is looking pretty damn good. We'll see what happens. I'm positioned for this. I'm already in it. I've been in this stuff before this chart. The time frame. I'm just riding. I love this stuff. Love it. I love seeing it. Love seeing the breakouts, and I do think the miners are going to take off probably pretty big. One of the few silver charts that matters. Really, silver is broken out on the quarterly, while the gold and silver ratio is still at 86. Is mind blowing. This means we have fuel to run to $107 silver just based on former historical tops, with gold not moving. If gold moves on up and we compress, let's get the good old calculator out, guys. Let's see what that's going to be like. Let's say we compress the ratio down to 30 to be conservative. Let's say gold's at 4,500. We go to 30, $150 an ounce silver. Pretty easy math. Yeah, definitely possible as we break through this gigantic cup and handle pattern. Breaking news from Eric. It says the Chinese government is now officially chasing capital gains tax on all of the profits that Chinese citizens made from investing in U.S. equities. Physical gold and silver will be the only escape door. The door is small and narrow. It's getting worse. So, Warren Buffett, without passion, you don't have energy. Without energy, you have nothing. Todd Combs, the earlier you find your passion, the better, because it won't seem like a chore to follow your dream. And you'll outwork everyone in the process because you like doing it. For freight futures, we've got dry bulk, Capesize up 1%, Panamax down 2%. And then tankers both flat today, VLCC and Suezmax. D.R. Horton just printed its best single-day gain since the great financial crisis. Take a look. Bottom, and maybe a bottom. Are we going to move higher in home builders? I listened to Lennar's earnings conference call. And if you guys want to ask questions during the weekend or something, I can answer whatever you like. But yeah, I'm not that bearish on housing like some of you guys are. Gold soared. Now copper's rising rapidly, and oil is next. It is next. You can see that we've got these. I think they're MACDs here. Let me see that. KST, yeah, maybe it's a strength indicator, but MACD coming up, and this one's bottoming and about to come up here at some point. It says gold moves first, copper leads oil, and oil usually moves last. I was looking for top talent. So Donovan Jackson says silver miners are my favorite setup within the commodity space right now. That's SIL and SILJ. Ready to break out here, looking pretty good. Yeah, they do look good. They do look good. Van Eck Steel ETF, SLX, is on the verge of breaking out of a 14-year base. You know what that means? The bigger the base, the higher in space. And guess what?
The US dollar has been sliding, with the DXY index now sitting around 97.4, its weakest level in over a year, and unable to reclaim its 50-day moving average. Even though it inched slightly higher from 2-week lows on Friday, it's still facing its sharpest weekly drop in a month. All eyes are on the upcoming August 1st tariff deadline and next week's central bank meetings, both of which add more weight to an already fragile currency outlook. Andy Hose doesn't mince words. Every primary commodity bull market has started with a weakening dollar. As the US dollar loses ground, capital tends to flow out of fiat currencies and into tangible assets. Commodities and emerging markets are typically the first to benefit from that rotation. Gold is already leading the charge. Momentum is building as the dollar softens and geopolitical instability grows. Analysts are beginning to float serious upside targets, with some suggesting gold could break through to $4,000. That view is reinforced by record central bank buying, as reported by Kitco, and an emerging trend of sovereign wealth funds quietly joining the gold accumulation. But this shift isn't just about gold. Investors are increasingly turning to commodities across the board. copper, oil, natural gas, and agricultural goods have all seen rising demand. ETFs tied to these assets are attracting consistent inflows, signaling broad-based confidence in a sustained rotation into tangible assets. Let's get back to the interview.
Winston says the Trump administration wants a weak dollar. I predict a drop. And this is the chart for the dollar. There's the channel support as we go up. And could we get a break lower? If we do, what does that mean? Every single bull market in commodities had this dollar getting weaker. And money rotates differently when the dollar weakens against other currencies. So if we get that breakout of that channel and we break lower where each one of these channel breaks were, this one here, so we're not back here, but we had a big bull market in commodities in the 86, 87 region. This one here is the 2002 era. And this one we could be at the beginning of a breakdown here. If it breaks down, well, you're going to see money rotate into commodities, emerging markets, and they are all set up and put in bottoming patterns already for that to occur. What does that mean if we go into emerging markets or whatever? So some of these emerging markets from about this point on to here returned a 20x. The whole damn ETF did. 20 times your money. There are companies that did 100x in that same time frame. Yes, that is how big of a deal this is. But you don't get those returns unless you get in early and you sit and you wait, and you might have to endure some pretty big pullbacks along the way. The same setup is there as the last setup. So what do you think is going to occur? Do you think we're just going to stay in the channel forever? I could debate that we could maybe get a bounce here a little bit, similar to maybe something like this, and then we break, get like a counter trend false move where people get all sorts of confused. Markets tend to do that. But yes, this is a huge opportunity. Everything that I see is in alignment for this to go and break down with time, not immediate. Now, Warren Buffett, if you're even slightly above average investor who spends less than they earn over a lifetime, you cannot help but get rich if you are patient. You can not help but get rich if you're a little bit better than average. Now, if you're way above average, which I hope we are, then we'll compress that time frame. I've compressed it. This is what I've done. I've learned about investing, and I'm getting better with time. I save a lot of money, and then I invest it. And if you're patient enough, it will happen. Here's some real estate guys. We've got Reventure Consulting down here. Well, that's his chart at least. U.S. housing market has reached its most unaffordable level in history. But I like what this is up here. 2014, something's got to give. 15, 16, 17, 18, 19, 20. Panic slam, rates to zero. Best time in 50 years to buy a home. Something's got to give in 21, 22, 23, 24, 25, 26. Do you see a pattern? All of these guys, these housing market bears. I started my channel in 2020. The reason I started it was somebody at work, they made a comment about not being, they don't want to buy a house because it's going to crash. And I just started laughing. I was like, no, it's not going to crash. There's no way. The underbuild scenario here is like the worst it's ever been in history in 2020. You've got the largest demographic coming into home buying years and the largest mismatch in history. And we're going to get a real estate crash. You know who was calling for a real estate crash? Who's that little guy? Graham Stevens. Kevin, Meet Kevin. That's what it was. Meet Kevin, Graham Stephen, and obviously Reventure Consulting. That guy's been bearish probably since he was born. I don't know if these guys just don't own homes. I have no idea. I know Meet Kevin and Graham Stephen make a lot of money, but the U.S. is relatively very affordable compared to other developed countries around the world. 40% of homes are paid off. 73.3% of mortgaged homes are below 5%. There's no SFR crash coming. And then another one says the problem today isn't with affordability relative to history. it's relative to expectations that all-time lows in ownership costs should be the norm. Prices and rates crashed simultaneously, and ownership costs plunged, but rents kept going up. The bump since was a mean reversion. This was basically the cheapest in history that we've ever had, and everybody's comparing to the cheapest time in history when interest rates were basically at their lowest when home prices were low. And that's what everyone compares to. We'll go compare it to when the market was tight, like 1970s and 1980, when interest rates were up. The Crude Chronicles, you won't hear about all the calls I get wrong, but you will definitely hear about the ones I get correct. This post was back in October of 2024 before the trade war. We are now seeing the year-over-year declines in U.S. production. So stop following the rig count. The less widely followed hard data, such as weekly hours worked in the oil patch, as well as durable goods data, points to a decline. And here we are finally getting a decline in oil production. It's just starting to roll over.
Precious metals aren't just reacting, they're recalibrating. Silver is no longer lagging. It's tightening the gap and rewriting the rules as capital flows toward more complex, finite assets. What used to be a gold-first story is quickly becoming a broader surge in commodity prices, with silver, copper, and even oil stepping up in a synchronized move. The currency backdrop is shifting, volatility is spiking, and structural imbalances in supply are meeting a wave of inflows that show no signs of letting up. This isn't a trend anymore, it's the market choosing new leadership. Is silver's rise just the opening move in a larger repricing of scarcity across the commodity spectrum? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.